Markets this morning are lower. We are expecting a fractional decline at the start of trading. The Dow Industrial is now at the low of the morning, down 76 points, 1/3%. The Nasdaq is nearing bear market territory. That means down 20% from the highs. Yesterday, the Nasdaq closed 19.5% lower than its recent closing high in August, as you can see from that chart. Technology stocks took a hit as Amazon lost 8% this week, and Facebook down almost 7.5%. Joining us right now is Mahoney Asset Management CEO Ken Mahoney. Ken, good to see you this morning. Thanks so much for joining us. Your reaction to what's been going on with tech in particular?
Well, I don't think it's an overreaction. I mean, it's easy to say that. I think the market's got to figure it out that we have don't fight the Fed, don't fight this Fed. I mean, this Fed's using 1965 textbooks to tell us that, you know, you have low unemployment, wage increases, and too much money chasing too few goods. You have inflation. And there's a whole bunch of reasons why we should not be raising rates and talking about raising rates in 2019, from the Brexit to, you know, the overhang with Mueller to all these problems that we have.
Yeah, but and yet you have to say to yourself, okay, so then why are you hiking? Why are you raising interest rates?
Well, again, I think it's that independent. I feel like the Fed raises rates till they break something, and they're breaking something already. And I just feel it's that independent thing. Okay, we're independent, but they don't realize the wealth effect that happens here, where, you know, investors look at their accounts every day now. They go online. You know, it's not they wait like quarterly statements. They see their assets go down, and they're going to react. They may not take the extra vacation. They may not, you know, do the home improvement that they're planning on doing. Those things are going to happen.
Yep. So earlier this year, you know, there was talk that the Fed's creating a bubble, that asset prices keep going up, the stock market keeps going up. Well, that's off the table now.
Right.
We no longer have that.
There's no Nike put.
For the investors at home who have lost money in their portfolios, I think it's important to speak to them and for them to understand that this doesn't mean you run for the hills, or this doesn't mean you have to sell. If you have companies like Apple that's gone from 230 to 160, that a lot of times you could look at that and kind of look past the Fed and look for opportunity based on the fundamentals of the underlying companies.
I agree. This downdraft has created a lot of opportunities, to your point. I mean, that's why we have the market. You know, some people overreact and some people are buying right there. And to your point, but again, if you have a 10-year horizon, this too shall pass. We'll deal with the different cycles. But short term, though, we are dealing with a Fed who's pretty, you know, pretty tough here. I mean, he is pretty hawkish. And remember on Wednesday, the question and answer session, it really, when the market started cascading lower, was around this, you know, $50 billion, the balance sheet.
Yeah.
You know, over the course of a year, that's, you know, well, it's a quick one, you know, $600 billion over 3 years is $1.8 trillion coming off the balance sheet.
Yeah.
That's a lot.
Yeah.
That's a lot for investors to absorb.
And it's a form of tightening, and that's why investors have been spooked. And the Fed on Wednesday said, well, now we're expecting 2 more interest rate hikes next year. Treasury Secretary Steven Mnuchin was on Fox Business yesterday reacting to the Fed's announcements and looking at the market's reaction in particular. Watch.
I think that the market was disappointed in the chairman's comments, but I would say if you look at the specifics, you can't just look at the headline, which was 2 more rate hikes. You have to look at actually the 17 dots on the dot plot. So each one of the governors and the people on the committee put their views. If you look at this, the high end of the range came down significantly, and there's still a pretty wide dispersion. So there's clearly people on the committee who think they don't need to raise rates much here. I think that with the advent of computerized trading, which has such a big part of the market now, combined with the Volcker rule, where you can't have market makers commit capital, you just have much bigger moves in both directions. And I think clearly you have a situation here where the market has overreacted to the Fed's comments, and you see program trading taking over. I would just emphasize U.S. growth a lot stronger than the rest of the world. U.S. business activity continue to see pickup as a result of the Tax Act. We think we're going to continue to see a lot of capital investment. So, you know, even the Fed said yesterday they see strong economic signs.
Ken, your thoughts? I mean, the economy right now is strong.
No doubt. But I feel there's this little pickle the Fed has us in now. We're rooting for good news as investors, right? So next time we get good news, let's say a job report comes out and they create more jobs. What's the first reaction? Oh, maybe that's 3 rate hikes. You know, this is the type of area that we're in. And if we get softer numbers, you know, is the Fed really going to listen to that? So I think we're in ourselves a little pickle here. Obviously, we got to respect the downward trend. And I'm not trying to be so negative because there are a lot of positives. But we get under the hood, though.
So are you a seller here, or do you want to buy stocks?
Again, right here, you can't be selling down here, especially if you have a long-term horizon. Yeah. You've been nibbling, averaging in. And by the way, you know, just keep averaging in, eventually get it right. But here's a sign where I think we're getting closer to a bottom. And you're seeing these net liquidations, $40-some billion a week coming out of equity funds. Now, that's not in August, September when we're setting setting records because most investors buy high and sell low. In fact, we saw inflows of tens of billions of dollars during that time, and now we're seeing outflows. Now, they look right at the moment. The only problem with that loop, though, is that money managers have to sell. They have to deal with those liquidation notices.
We'll leave it there. Ken, good to see you.
Good to see you also.
Thanks so much. Ken Mahoney there.